As of 9:50 a.m. Eastern Time on November 5, 2025, shares of SoundHound Ai, traded under the ticker SOUN, are navigating treacherous waters. The stock is currently trading at 15.205 per share, reflecting a modest intraday gain of about 0.5% or 7.5 cents. But that tiny green number, following a previous day's close of 15.13, is deeply misleading and masks the extreme volatility just under the surface. The stock opened the session significantly higher at 15.56, even pushing to 15.61, but was almost immediately slammed down to a morning low of 15.02. This whipsaw action isn't just noise, it's the market bracing for impact. The expectation from many retail traders looking at forums and social media is that SoundHound is on the verge of its next major leg up. But the reality, shown in the charts and the data, is that the stock is hanging by a thread ahead of its critical third-quarter earnings report, which is due tomorrow, November 6th. This isn't a stock in a healthy uptrend. It's a stock in a holding pattern, with both bulls and bears refusing to blink before the numbers drop. The common belief, the narrative that has propelled SOUN from a 52-week low of 5.41 to a high of 24.98, is one of disruptive technology. SoundHound is seen as the independent leader in conversational voice artificial intelligence. When investors think of SOUN, they think of its massive $1.2 billion bookings backlog, its marquee partnerships with automotive giants like Mercedes-Benz and Hyundai, and its aggressive expansion into the restaurant space, powering smart ordering for chains like Chipotle. Last quarter's staggering 217% year-over-year revenue growth is a figure burned into the minds of the bulls. The expectation is that this company is the next NVIDIA of the AI voice sector, a pure play that will eventually dominate its niche, crushing competitors and rewarding early investors. This is the story that gets told online, the one that fuels the buy-the-dip mentality every time the stock pulls back. But the reality of the immediate situation is far more complicated and far more bearish. The stock didn't just wake up here. Yesterday, November 4th, the stock collapsed, falling 11.57%. It has now fallen in 6 of the last 10 trading days, shedding over 17% of its value in that short period. Today's action, gapping up at the open only to be sold off immediately, is a classic sign of distribution, where any remaining optimism is being used as liquidity for large sellers to exit their positions. The market is not positioning for an earnings beat. It's de-risking. The core of the expectation versus reality disconnect is this. Retail investors are focused on revenue growth and partnerships, while the deeper-pocketed market is staring at the balance sheet, the cash burn, and the complete lack of profitability. Analysts are projecting a loss of 3 cents per share for the quarter, and despite management guiding for positive EBITDA by the end of 2025, the market is signaling it has lost patience and needs to see proof. Now, let's talk about the elephant in the room, because in SoundHound's case, it's not just an elephant, it's a herd. We're talking about the short interest. This is not a stock that is merely being overlooked. It is being actively and aggressively bet against. According to the most recent data from Fintel and NASDAQ, a staggering 102.84 million shares of SOUN are currently sold short. This translates to an astronomical 28.07% of the entire public float. To put that in perspective, a short interest of over 20% is considered extremely high. This level of 28% indicates a profound, deep-seated conviction from a large segment of the market that this stock is overvalued and headed significantly lower. The days to cover, or short ratio, is currently fluctuating between 1.67 and 3.51 days, depending on trading volume. This means that based on recent average volume, it would take nearly 2 to 4 full trading days for all short sellers to buy back their shares, assuming they all decided to cover at once. This is where we must provide actionable insights for investors. When you see a short interest that high, the first assumption is often that a massive short squeeze is imminent. This is what many on social media platforms are counting on. The thesis is that a strong earnings report tomorrow will ignite a buying frenzy, forcing the 102 million short shares to be covered, sending the stock to the moon. But
we must look deeper. The next crucial metric to check is the short borrow fee rate. This is the interest rate short sellers must pay to borrow the shares they wish to sell. If a stock is hard to find and in high demand for shorting, this rate can skyrocket to 50, 100, or even 300%. For SOUN, the borrow fee rate is surprisingly incredibly low. Data from Fintel shows the current rate at just 0.54%. This is not a typo. It is virtually free to bet against this stock. What does this tell us? This is the key piece of reality that clashes with the squeeze expectation. A low borrow rate means there is an enormous supply of shares available to be lent out. This implies that the largest holders of the stock, the long-term institutions, are not afraid of a squeeze. In fact, they're more than happy to lend their shares to short sellers to collect a small, risk-free fee. They do not believe the stock is about to explode upwards. If they did, they would recall their shares and refuse to lend them. This combination of extremely high short interest and an extremely low borrow rate is the market's way of saying that the bearish case is not a fringe theory. It's a mainstream institutional position. Furthermore, a look at the off-exchange short volume from November 3rd showed that 46.87% of all short volume occurred in dark pools, away from the public exchanges. This is a hallmark of large institutional trading. And if we look at fails to deliver, or FTD data, there was a significant and anomalous spike in FTDs in late September, with over 1.65 million shares failing to deliver on September 24th alone. While FTDs can occur for clerical reasons, persistent spikes like this are often cited by retail investors as evidence of market manipulation or so-called synthetic shorting. Regardless of the cause, it adds another layer of complexity and distrust to the trading environment. What's your take on that 28% short interest? Is this a smart bear thesis focused on profitability, or is it setting up for a massive post-earnings squeeze? If the short data wasn't convincing enough, the institutional and insider activity paints an even bleaker picture, one that directly contradicts the retail hype. Let's start with the insiders, the C-suite, the people who know the business better than anyone else. In the last 6 months, SoundHound insiders have executed 33 trades. Of those 33, 0 have been purchases. The CEO, Kevin Mahajan, the FCFO, Nitesh Sharan, the TTO, Timothy Stonehawker, the OOO, Michael Zagaris, all of them have been selling shares, not buying. This is a massive red flag. While some sales can be explained away as planned compensation or for tax purposes, a complete lack of any open market buying from anyone in leadership, especially as the stock is pulled back, signals a severe lack of confidence in the stock's current valuation. But the insider selling is just a footnote compared to the institutional evacuation. This is the smart money, and the data is shocking. In the second quarter of 2025, June, institutional ownership in SoundHound stood at 46.6%. As of the most recent filings for September 2025, that figure has collapsed. Institutional ownership is now reported at just 1.0%. This is not a rotation, it is a full-scale abandonment. We're talking about major hedge funds and asset managers liquidating their positions. QuiverQuant data shows D.E. Shaw, one of the largest quantitative funds in the world, dumped 6.4 million shares. Morgan Stanley sold off 5.8 million shares. Point72 Asset Management, run by a legendary trader, liquidated its entire position. While some firms like Bank of America did add to their position, the overwhelming trend is one of exit. The very institutions that retail investors believe are on their side have in reality already sold their shares to them and headed for the door. So what is this company that everyone is fighting over? Sound Hound Ai has been around for nearly 2 decades, slowly and methodically building its voice AI platform. It is not a fly-in-the-night organization. Its technology is genuinely impressive, allowing for complex multi-part voice queries. Its Houndify platform allows any business to add a conversational assistant to its product. This is why it has been so successful in the automotive industry, where manufacturers are desperate for an alternative to Apple's CarPlay or Google's Android Auto. They want to own the customer data and the in-car experience, and SoundHound provides that. The $1.2 billion bookings backlog represents long-term contracts with these automakers and with restaurant chains. This is the bull case, and it's a strong one. The company has a massive locked-in revenue stream that should, in theory, guarantee growth for years to come. The recent acquisitions of Amelia for enterprise AI agents and Sync3 for restaurant solutions have only strengthened this pipeline. This all comes to a head tomorrow. The entire market is now focused on the Q3 earnings report. Wall Street is expecting revenue of approximately $40.93 million, which would represent a 63% increase from the same quarter last year. While 63% is strong for any normal company, it's a sharp slowdown from the 217% growth reported last quarter. The market will be watching for any sign of weakness, any hint that the AI boom is fading, or that competition from giants like Amazon, Google, and Apple are starting to eat into their market share. More importantly, investors will be listening for any update on the path to profitability. The company has a solid cash cushion of over $200 million and no long-term debt, giving it a healthy runway. But that cash is being burned. The bear thesis and the